Welcome to the DeFi Standard. This is Patty XRP, and today we're going to dive into some conversation surrounding the recent white paper release from Alliance Block for their new model for an automated market maker DEX that will be, I assume, operating within their layer 2 protocol and will give significant benefits to liquidity providers. And so with that, we're going to kind of start off with, brief overview of, what is a liquidity pool, what's a DEX, AMM, all that good stuff. And, what are some kind of metrics you need to know around that. If you've seen some of our past videos on this will be more of a refresher than anything new until I kind of get into this new design for an automated market maker that Alliance Block is pioneering here. So with that, I'm going to bring up this lovely spreadsheet we have here that can calculate impermanent loss. And impermanent loss is a big deal when you're going to be a liquidity provider providing assets to a liquidity pool on a DEX and trying to earn fees via liquidity mining. So with that, the way that a liquidity pool works, especially going off the automated market maker model from Uniswap, which uses something called a constant function market maker. Basically just means that there's this variable within it that's called K. So it's the constant product, and it uses this constant product to kind of rebalance the pool so that the assets within it maintain a 50-50 ratio. And that's under the Uniswap model. So Flare Finance will be something on the Flare network and then the Songbird network as well that will be utilizing this constant function market maker model, which when you enter into it as a liquidity provider, you need 50-50 value of two different assets. So they need to be equal in USD value. So we could do a situation where, let's say in the future, you want to put 20,000 FXRP at a price of $2 into a liquidity pool. That means you would have to also, if the other asset denominated in that liquidity pool is a stable coin, so YUSD in this instance, you would put up 40,000 of those tokens at $1, and that would give you equal value when you enter the pool. However, whenever there's a deviation in the initial spot price between the two assets that you entered into a pool with, or that ratio between the two assets, then there's something called impermanent loss. This is due to the way that the automated market maker functions. And with it, it's an opportunity cost between either holding the two assets that you put into a liquidity pool or what your return is when you exit the liquidity pool with the two assets you put in there. So in this example, we're going to say that FXRP goes from a price of $2 to, let's say, $6. So this would be a 3x. And we can kind of look at what would happen if we exclude fees when this happens. So now our new price ratio is 6-1 rather than 2-1. So if the pool rebalances in this scenario, you would now have 11,547 FXRP if you were to exit, but you would have close to 70,000 YUSD. Now, this would also equate to a higher value than you entered, which would be around $138,000. However, with that, if we compare it to just holding these two assets, that's actually 13.4% less return than you would have gotten for holding these assets, and the value difference is $21,000 in that scenario. However, if you include fees and also maybe additional rewards, like Flare Finance is offering YFIN on their Flare Finance platform to liquidity providers in certain crypto to stablecoin pools, that also can help you get in the green by doing this. And these extras, these extra incentives are there to kind of make sure that it's a profitable endeavor for liquidity providers, since they're providing a really important service to people that are within a decentralized ecosystem, allowing their assets to be shuffled around and swapped between different people, either in return for fees or some kind of additional yield farming rewards. So the idea is basically the fees and any additional rewards will outweigh this impermanent loss to where you actually are in profit for having put those two assets into a liquidity pool. So with that, since we kind of have that all ironed out, I guess I would also add, whenever you're in a liquidity pool and it's a crypto to stablecoin asset, basically the asset that's rising in price, you're going to be selling out of the whole time. and you will be accumulating more of the cheaper asset. And then let's say FXRP goes down in price. Well, you would be accumulating more of that over time. So there is still impermanent loss to the downside. However, you end up with more of the token that's losing value compared to the other one when it moves down. So, like, let's say if we went to 50 cents here, you would see that after the pool rebalance, you would actually have 40,000 FXRP rather than 20,000, but you would have 20,000 YUSD rather than 40,000 YUSD. Now, this is a pretty significant move down. That's a 75% drop. And your impermanent loss in that situation is about 20%. So you actually would have been better off holding FXRP and YUSD to the downside as well. But that's where the fees come in to kind of counteract this. And the longer you stay in a liquidity pool, the more fees you're going to earn. Also, the larger share of the pool, the more fees you're going to earn. And then on top of that, if there's higher volumes in the pool, then you're also going to be able to earn more fees. So those are all things to take into account as well. So moving on, I want to get to this next part, which is kind of focusing on the Alliance Block DEX that they're building out here. And with that, they did a series of tests to kind of back test it against some of the pairings they had on Uniswap as well as Balancer, and kind of showing what their modified DEX would be able to do for liquidity providers, which is significantly decrease the impermanent loss that happens whenever the spot price of two assets deviates over time. And we'll really kind of showcase that in the white paper once we get there. But basically, want to start off with what they're saying. So our DEX works directly on the intrinsic mechanism of the automatic market maker with a new approach to reduce the impermanent loss. This new methodology allows Alliance DEX to minimize the risk of impermanent loss compared to standard DEXs and the volatility of each liquidity provider's profit and loss when entering the DEX. In the below, the LP returns will be composed of both the cumulative reward from trading fees as well as the negative impact from impermanent loss. So right here, this figure we're about to look at illustrates that their model of a DEX is going to be more effective. So it's going to display a backtest of the pairing between the ALBT token, which is the native asset of Alliance Block Protocol, and wrapped Ether. And this includes returns from the trading fees from time zero onwards. This will be over the course of around a 6 or 7 month period here from November 11th, 2020, ending in May 25th of 2021. One thing we should note, the market was extremely volatile over this time period to the upside and to the downside. So you're going to get a pretty, broad overview of things that can happen once we take a look at this. So this graphic here, this is going to show us the spot ratio between the ALBT token and Ethereum over time. So in instances where ALBT is increasing in value to ETH, you can see that it's moving up this way. And then when it's moving down, it's decreasing in value compared to ETH. Also, we're going to show basically what happens on Uniswap versus Alliance DEX over this time period. So the right axis is going to show us basically changes in the spot price between those two. Additionally, the bottom x-axis is going to show us the time in years, which this is occurring. And then our left y-axis over here is going to show you negative, the negative effects of impermanent loss plus trading fees. So with this, you can see if we start off at this price ratio down here at time zero, obviously there's no profit or loss for being in the Alliance DEX. However, we can see that during this whole time with extreme volatility between these two token assets, that the Alliance DEX is consistently bringing positive returns for anybody that provides liquidity to it. In fact, if you exit even during these times, that may be the worst time to exit, which is when the price deviates the most from your initial entrance point, you are still in profit. And then at the end, you can see as the volatility dies down, the assets come back to kind of their starting correlation after around 6 months, that the Alliance DEX would have given a 40% return versus, just holding those assets. So to me, that's extremely powerful. And also, you can see at many times during this process, if you were to exit in one of these areas, it's considerably higher than what you would get with Uniswap. In fact, during some of these times where the price deviated the most, you would have had -10 to -20% returns potentially if you were in Uniswap and exiting at that time. And this is another important thing to note that I didn't really mention about impermanent loss. It's called that because technically it's unrealized until you exit the pool. So, if you were on Uniswap while, the price deviated a lot from the initial ratio, if you kept providing liquidity and didn't exit, you can see how that starts to normalize over time as the prices come back in line with each other. So, the longer you can stay in, if the market does kind of come back to that initial price ratio, the better off you're going to be as you were accumulating fees that whole time, and exiting at the end would, minimize any impermanent loss. Essentially, here, 6 months later, if you entered right here and that's the spot price 6 months later, I mean, even if you had no fees, the impermanent loss would be extremely minimal in this situation. All right. And then moving on down here, they said in the above example, when the spot reached its maximum, the returns of the LPs between Alliance DEX and Uniswap V2 reached a difference of more than 20%. That's a large amount there. However, the IL is reduced at the end of this time interval for both DEXs since the spot reverted to its original value. So that's kind of what I was just explaining there. So this is, really exciting. It's going to be something that comes out in the future. I think they're going to have a DEX week coming up at the end of the month where they're going to kind of showcase a lot more that's going on with this. Also, I know that you're going to be able to, in the future, provide a single asset as a liquidity provider rather than doing two assets. So that's something else that really may encourage other people. However, I will add, if their DEX works this well in practice, I don't know how much incentive there is for them to offer any kind of additional rewards from farming or anything like that. I imagine the trading fees that you can have, especially with the significantly minimized impermanent loss, is going to be plenty for anybody looking to be a liquidity provider in the future. Something like Flare Finance that has this more volatility in the returns similar to Uniswap. That's why they're offering additional incentives to counteract that. So with that, that's going to kind of generally cover what's going on here. I'm going to get into a little more in depth with the white paper. It's kind of really math heavy, and I'm going to try to do my best to explain it here. So let me get that pulled up. All right. So this was released on written and published on November 3rd, 2021. And with this, it's their Abstract States Alliance block proposed a new approach to automatic market making and AMM by synchronizing two constant function market makers. The methodology combines the advantages of individual constant function market makers and reduces the downside risk for liquidity providers. It is particularly suitable for assets with high volatility that can induce high impermanent loss for LPs. I definitely know a lot of people are weary about, using maybe FXRP on Flare in a liquidity pool as a liquidity provider. So this could be a future option once Alliance Block is integrated with Flare and Songbird to do that instead. It's something we'll continue to cover as they release more information on it, and they will have a test net available that lets you see this in live action as well in the future. So, with that, there's some different kinds of constant function market makers, and here they're going to really focus on Uniswap and Balancer. Uniswap is, your basic 50-50 liquidity pool. Balancer actually does some different ratios. They have ones that are like 10 to 90 or 5 to 95, and they kind of shift the risk to one side as it's asymmetric rather than a symmetric kind of outcome with Uniswap or this Alliance DEX. So moving on down further. All right, so here they kind of have a little take on impermanent loss for geometric mean markets, which is what we're talking about here with AMMs. So they say, as discussed, the liquidity providers will earn trading fees by providing their assets to the DEX. These will then be used as reserves for trading. This means that LPs, which are liquidity providers, make a choice to switch from a static buy and hold portfolio where the amount of assets stays constant over time to a dynamic portfolio where their assets will fluctuate according to the AMM dynamic and market movements. It is natural to compare the evolution of LPs' liquidity providers' holdings when they enter a DEX versus a buy and hold portfolio. And, essentially this is an opportunity cost. So moving on down further in this section, it states basically, so this is for the Alliance DEX Synchronize AMM. So they say we introduce a new type of AMM, which combines the properties of several constant function market makers together. The goal is twofold. On the one hand, this approach allows to gain flexibility on the features of the resulting AMM. On the other hand, as a direct application of this technique in driving results of the paper, we propose an AMM with strongly reduced downside risk for liquidity providers. The latter comes from the interesting properties of geometric mean markets, constant function market maker with asymmetric weights, which improve the impermanent loss either on the rise or on the fall of the spot. So essentially, my understanding of what they're trying to do here is they're going to have two constant function market makers in the background. Both of those will, have two assets within them, it seems like, but they will have asymmetric weights. So what that means is maybe you have XRP to USD where it's 95 to 5, and then USD to XRP where it's 95 to 5 in the other pool. And basically, those will be synchronized together and then displayed as one AMM to the end user, which that's kind of what is going to provide this impermanent loss hedge and reduction with their AMM design. So moving down further in this paper, they state something really interesting here. So they want to note that an important feature of the Sync AMM, which is shared by most constant function market makers such as Uniswap or Balancer, is that liquidity addition or withdrawal does not impact the P&L of other liquidity providers within the DEX, which is a good thing to know. And then additionally, they have a part here, so time series under stress markets. So they say the Sync AMM is consistent both on the rise and fall of the spot price, which provides a strong improvement of impermanent loss in the two scenarios. As a benchmark, they also provide the impermanent loss without trading fees, in which they notice a similar behavior where the Sync AMM provides consistent improvement compared to Uniswap in both up and downtrend scenarios. And so with that, they summarize the Sync AMM improves the liquidity provider returns even when large swings of spot prices occur. So kind of thinking back to um, the graph that we looked at earlier, basically that's what that was showing, was even when there's large swings in the market, there's still a lot of return with this. So to me, that's very important. We can see another scenario between Alliance DEX, Uniswap, Balancer with different weights. And you can see there's some instances where Balancer, if it's weighted in the correct direction, does, provide better returns. However, that puts you more in a, position to kind of timing the market and picking which kind of weighting you want to go into, dependent on where you think the market's going to move. While we see the blue line here, which is the impermanent loss plus trading fees of the Alliance DEX, it's basically symmetric to both sides. There's very little area for downturn, regardless of which way the spot price has moved. So that's incredible. This is, out of all four of these, this is the only one that's basically providing returns the entire time, no matter which way the market moves. All right. So, in conclusion, the last thing I just want to touch on this. So, they say in this article, we focus on the underlying mechanisms of the market maker by proposing a new approach combining properties of different constant function market makers. The Alliance DEX combines two dual asset geometric mean markets with symmetric weights and provides an improvement of the impermanent loss in every spot market scenario, resulting in an average increase of returns for liquidity providers. Additionally, our numerical results show that the Sync AMM combined with the usual 0.3% trading fees lead to positive returns in a large amount of market scenarios, even when the spot deviates drastically from the liquidity provider's entry points. And kind of to touch on this, they talk about a lot of the math behind this, as well as some simulations they ran. They did a bunch of Monte Carlo simulations, which is really commonly used in the world of finance. That was something that I learned how to do back in the day, but honestly have no idea how to do it anymore. But it's very common out there, and basically just runs through as many scenarios as statistically possible to try and show you outcomes of all different kinds of things. And the last part we'll touch on down here at the bottom is The symmetrical average slippage makes the proposed DEX suitable for trading in both directions as opposed to balancer with uneven weights. So this actually improves on slippage as well. This feature combined with the IL improvement should in principle attract liquidity providers and hence increase the available reserves, which as a consequence will reduce the slippage, making the proposed solution beneficial for both LPs and traders in the long term. Finally, this new approach to AMMs could potentially open other research topics on additional improvements of the impermanent loss, reduction of slippage costs, as well as new features such as single-sided liquidity provisioning, which is part of their roadmap for this DEX. And then moving on to next steps, extension of this work in the decentralized exchange will include a new approach to single-sided liquidity provisioning. This will allow investors to deposit funds in the token of their choice instead of the pair of assets. The tokenomics will be released in an upcoming document posterior to the delivery on the testnet of the DEX. Alliance Block will also provide new features in the next steps, namely a treasury contract associated with yield and insurance strategies, rewards associated with liquidity provisioning risks, as well as a liquidity layer optimizer. More details about these features will be released by Alliance Block in due course. Oh man, having a hard time with words there at the end. But however, all that stuff is really exciting. Mickey and I have kind of given a broad overview of Alliance Block in a past video, which I will link at the end here. And, just to say, this is something that will evolve as I and Mickey learn about it more, and definitely will share back with everybody. And just really exciting that this project is going to be part of Songbird and Flare Network in the future. I will add, if it's something that maybe you want to own, but you don't want to buy right now, they've been launching on Binance and Ethereum so far, and they have liquidity pools for the ALBT token versus other assets, whether it's USDT, ETH, WRAP BNB. And with that, that allows you to liquidity mine the ALBT token for limited periods of time if you provide liquidity to those layer one DEXs. So that'll be another way to earn in the future, as well as any protocol ecosystem rewards within the Alliance Block layer 2 protocol. So with that, I'm Patty XRP. This is the DeFi Standard, and I'm out.